Good afternoon and good morning, everyone. It is March 11th, Tuesday. Welcome to Morgan Stanley Asia TMT Webcast. My name is Daisy Dai, Greater China Semiconductor Analyst based in Hong Kong. Today we also have Tiffany Ye and Lucas Wang from Greater China Semiconductor team based in Taipei, and Joanne Lau from our Internet team. First, some housekeeping things. Please note that this event is for Morgan Stanley institutional clients and financial advisors only. This event is not for members of the press. If you are a member of the press, please disconnect and reach out separately. Please note that this webcast and your questions may be recorded. Today we will discuss many interesting topics, feedbacks from US TMT conference, latest CoWoS booking, specialty FPGA, and the Meituan. During this webcast, you can send us questions at any time from Ask a Question text box. Now let me kick off today's debate with specialty FPGA first. FPGA is a very niche market in semiconductor industry because FPGAs can be reconfigured on the fly. That makes them perfect for applications where mission parameters may change during the mission. In China, specialty FPGA market is dominated by local players like Unigroup Guoxin, Shanghai Fudan, and Chengdu Sino Microelectronics. We estimate RMB 1 billion revenue opportunity for specialty FPGA vendors each year. How we get this number? So similar to SpaceX Starlink, which proves the economic feasibility of large-scale LEO satellites, China has launched its own LEO satellite projects. Chinese organizations have filed applications to the International Telecommunication Union (ITU) for the launch of a total of 51,300 LEO satellites. These three major Chinese projects are GW constellation Wang, Space Sail constellation Tianfan, and Honghu constellation. These each planning to launch over 10,000 satellites by 2035. So in our base case scenario, we only assume 1/3 of these filed satellites to be launched in next 10 years. So each year around 1.5K satellites. The content value of specialty FPGA in one LEO satellite is around RMB 1 million. So with pricing decline 5% annually, that gives you RMB 1 billion revenue opportunity on average each year. We expect Shanghai Fudan will be the major beneficiary of this trend because its specialty FPGA was adopted in Beidou navigation satellite, which is a mid-Earth orbit satellite. So we assume 70% market share for Shanghai Fudan. So that will be around RMB 700 million additional revenue for the company. Also, regarding the cycle, we have been bearish for this segment for almost 2 years. Now we are seeing signs of bottoming out. So in 4Q 2024, Shanghai Fudan both revenue growth and the gross margin inflected. And also you can see on the left bottom chart, this is the earnings revision breadth of Unigroup Guoxin. The trough of earnings revision breadth was in mid-2025, indicating the negatives largely reflected in the consensus earnings. Also, as you can see on the right bottom chart, the downstream company's order is stabilizing and slightly improved in third quarter 2024. And lastly, 2025 is the last year of 14th five-year plan. Specialty FPGA market is a kind of policy-driven market. And normally, specialty FPGA has decent growth in the last year of each five-year plan, like in 2015 and 2020. So all in all, we see a good setup for specialty FPGA growth in 2025. Within specialty FPGA space, we prefer Shanghai Fudan over Unigroup Guoxin because its revenue growth and gross margin inflected last quarter, while Unigroup Guoxin was still on the downtrend. Now let's move to the next topic, CoWoS booking. So Tiffany, what's your latest view on CoWoS booking? Any order cuts for NVIDIA or non-NVIDIA customers?
Yes, thanks, Daisy. So for I would say for all these AI semi vendors, everyone wants to win in this AI game, but at the end of the day, someone has to lose. So Joanne already shared his concern about the ASIC enthusiasm recently. From TSMC's CoWoS perspective, which has been the biggest bottleneck, we think customers were overbooking based on their bull case previously. But the reality is that most of them are losing market share to NVIDIA in 2025 and missing their bull case targets. For example, AMD, Broadcom's Google TPU, and Intel Habana have been cutting forecasts in CoWoS. AWS Trainium demand is strong, but the 3nm Trainium 3 won't start production until late 2025 per Alchip's revenue trend. Hence, we have seen some CoWoS double booking released recently. So a lot of investors are wondering about NVIDIA's booking at TSMC. So we don't see any cuts for the front end 4nm wafer side from NVIDIA. However, given the demand shift from CoWoS SB300A, which was targeting enterprise customers, we see some demand shift to the B300 series, which is leveraging CoWoS-L. We now break down the 450K, which was originally 465K units of NVIDIA CoWoS booking as around 390K of CoWoS-L, mostly for B300, 50K of CoWoS-S, mostly for H20, and lastly 10K of CoWoS-R for AI PC and auto, based on our latest supply chain check. Given this incident, there's no need to rush CoWoS capacity expansion. We had indicated TSMC could increase its CoWoS capacity to around 80K wafer per month by end of 2025 during last September, but now it seems the supply chain will more likely build to 75K wafer per month by end of 25 only. Our 26 estimates for expansion to around 100K wafer per month remains unchanged, which still implies around 50% worldwide growth for CoWoS shipments in 2026, which we still think is a strong growth profile. Yeah, I'll hand back to Daisy.
Yeah, so also this morning, we see there are lots of upgrade in the memory space, Phison, Winbound. So where are we in this memory cycle? And also the stock rallied a lot year to date. So what's your view? How much is pricing and what is missing by the market?
Yeah, thanks, Daisy. So we think that the disciplined supply seems to help NAND module demand. So Phison held earnings call last Friday, and it indicated that after the Lunar New Year, two NAND suppliers increased wafer price by around 9 to 11%. And we also see that SanDisk also issued price hikes for channels and consumer customers starting April 1st. Phison also commented that China's NAND prices are the highest in the region given strong demand. It also sees some edge AI creating organic demand as they need to consume SSD every 1 to 3 months. We think overall the comments to get or our channel check all bode well for all indicate a great market for NAND in 2025. So in our last month memory refresh note, we indicated that NAND price could start to stabilize into second quarter thanks to better supply side controls. But it seems that the schedule has pulled earlier a little bit. So Phison indicated that they see some shipment increase in February, which led to their monthly sales growth of around 25% MOM, and they indicated that in March it's likely to see some price hike. Besides that, management sees strong demand to 2025, and they are even worried about not getting enough NAND for second half this year if the production cut in that fourth quarter impacts 2025 supply. As a result, the company plans to accumulate inventory in first half this year, which usually is a sign of cyclical recovery based on historical patterns. So we think the NAND module price rebound is likely to occur earlier in first quarter. If early tariff pull-in and China subsidy demand could last longer than expected, we think the price rebound might be even stronger. Yeah. So for the stock implication side, as NAND modules are seeing demand recovery, we upgrade Phison and Longsys this morning, and also stay overweight on Simo. We also upgrade Wingbond to overweight given their logic and NOR and some of the non-China specialty driven side are bottoming out. And we also see them having some wafer-on-wafer projects from US-based customer like Qualcomm. But we still stay underweight on Nanya Tech given long tail CXMT competition and no wafer-on-wafer project win in the near term. On the other hand, as China is still ramping up memory projects aggressively into 2025, we favor key equipment names like ACMR, AMEC, and ARA. Thanks, Daisy.
Thank you, Tiffany, for this very comprehensive update on the memory space. So Lucas, TSMC, Alchip, and Silergy, these three companies attended our US TMT conference in San Francisco last week. I think for TSMC's geopolitical tension, Alchip's competition versus Marvell, and Silergy, how is their analog cycle. So what is the key feedback from these companies during the conference?
Thank you, Daisy. Morning, this is Lucas. For TSMC, from the core debate or conversations around the investor and Mr. Wendell Huang, the TSMC CFO at our TFT conference, is mostly around this additional 100 billion capex in the U.S. Mr. Huang has said that TSMC always invested in line with customer demands, including this investment for phase 4 to 6, which is also in line with what C.C. Wei have mentioned during the press conference with our President Lai in last week. And he also said that the U.S. fab will scale up over the next few years with customer support. The company first U.S. phase 1 fab of the 4nm production is already running at high volume. And the company is considered to moving ahead of schedule for phase 2 and 3 in Arizona. Original schedule for phase 3 in Arizona is around 2030, which could consider to be pulled in earlier to 2029 if demand is strong. So in the long term, once all 6 advanced node fab in the US are complete, TSMC expected that it could account for 20 to 30% of global 2nm and below capacity. And also regarding potential margin impact and also the wafer price adjustment in the US, TSMC reiterated that its expectations of 2 to 3% margin dilutions from overseas fabs over the next few years remain unchanged. And we think that the margin impact does not increase after this additional 100 billion capex announcement in the U.S. compared to its guidance during earlier earnings call is because we believe the majority of this investment should be after 2029 or 2030 when the phase 3 fab in Arizona is built. So because of this U.S. production is mostly in response to customer requests to the global manufacturing flexibility from TSMC. So we believe that those U.S. customers should share the bill for TSMC U.S. productions. And right now, the U.S. fab production is more expensive than in Taiwan for sure, given the smaller scale and higher cost. And also involved alongside the other development ecosystem. However, we think this should improve over time as scale and ecosystem improve. So TSMC long-term target of its margin of around 53%, we think is still achievable. And there are also, last but not least, the questions that, or the topic that investors are clear about is that the potential JV and tariff. And it is similar to what TSMC has suggested in their first quarter earnings call, that they have ruled out a fab or asset acquisition in the US. However, they didn't rule out the alternative that would make sense for shareholders. So whatever TSMC choose to do in the future, we still believe that they need to spend a lot manager role or HR capacity in the US. But in terms of tariff, we think that after this $100 billion CapEx announcement, the chance for US government to implement tariffs on Taiwan semi, the chance would be could be slightly lower compared to a few weeks ago. And last but not least, for TSMC, that they reiterate that the AI demand is still strong. During the press conference for C.C. Wei and President Lai, C.C. Wei indicated that the demand is, AI demand is very strong, that the related capacity are all booked for from 2025 to 2027. This also reaffirmed that TSMC will likely double its CoWoS capacity in 2025 based on customer demands. And for Alchip, we got a timely update from the management last week at our TMT conference, especially after Marvell results a day before. Although Alchip management didn't want to comment on its competitor or to be too specific on major customer projects, but based on our recent research and also management reiterations, we believe Alchip is preparing for a 3nm ASIC mass productions right now. And this mass productions could be perhaps as soon as the year end, which is no difference from what we have been seeing over the past few months. And when asked about the financials of the 3nm project outlook, the management of Alchip reiterate that his guidance for 2025 to 2027 revenue CAGR of 40 to 50% is unchanged. It's based on the current design win in the pocket. So any further, any other customer win will also be upside for this growth target. And when asked about the next generation 2nm opportunity, the management just say that their first priority right now is to make sure this 3nm project as productions goes well. And also they'll try to secure and then they'll try to secure the next generation of the 2nm project. And also the decision for this 2nm project should come around third quarter this year. And lastly for Synergy, Synergy will host its fourth quarter earnings call at 2:30 p.m. Hong Kong time on March 13, which is this Thursday. And we Morgan Stanley will also host a post-resource virtual NDR with Synergy chairman at 9 p.m. Hong Kong time on the same day. For 2025 preliminary outlook, the company expects revenue to grow more than 20% in 2025, and consumer may regain some market share from both new products and old products. And also the China trading subsidy should support the replacement cycle. Regarding to computing and auto industry, the management just guided that the company will be driven by data centers mostly, and the auto China customer demands will drive most growth this year for Synergy. So overall, management still expect 2025 gross margin to be in the range of 52 to 53%, and they will still benefit from the high-end products in terms of the gross margins, but slightly offset by the commodity. And however, compared to the recent full-year outlook, we still expect first quarter revenue for Synergy to be guided down to around 10% quarter-on-quarter, to be down 10% quarter-on-quarter. Although we believe the cycle of PMIC have already bottomed and is likely to reach the bottom, but the pricing pressure is likely to be eased. And those global IDNs are turning more optimistic on China analog market. But overall, we are still seeing the first quarter demand still kind of lukewarm compared to brighter outlook in the second half this year. So we are expecting that management to guide down first quarter revenue to be down 10% quarter on quarter. Yeah, and so overall, we suggest that on synergy, we could overlook the short-term headwind, especially for the fourth quarter, and to look on the long-term opportunity in AI and HPC. Right now, the synergy strategies is trying to differentiate themselves by pushing the technology in, and especially on process nodes, rather than just competing on by SCOT. Also, we are seeing synergy senior hire from PI and ADI have helped synergy penetrate global leading AI customer pipelines, including both PMIC and signal chains. So we would like to hear from management more about this potential revenue contributions in 2026 and 2027 on these US AI and CSP accounts during upcoming earnings call on this Thursday. Yeah, and I will pass back to Daisy.
Thank you, Lucas. So during this webcast, you can submit your questions at Ask a Question text box at the left-hand side of your screen. Now, let's move on to Meituan. Joanne, you published an insight report on how Meituan can tap into $30 billion Mid-East opportunity. Can you walk through the key investment thesis for Meituan?
Yeah, sure. Hi guys, I'm Joanne from China Internet team. So the team actually published Meituan Kita's Middle East expansion opportunity last week. So very quickly on some high-level takeaway from the report. Firstly, as you can see from this slide, the Middle East market is actually currently at around $17 billion market size. Within that, Saudi Arabia is actually the biggest. So it's around 50% of the whole GCC. So the market size is around $9 billion now for Saudi Arabia. And then the UAE is actually the second largest, but then it is still a lot smaller than Saudi Arabia. It is like half of Saudi Arabia, at around $4 billion now. So if we look at the entire growth trend for Middle East, it's actually growing very fast. We expect the TAM to be around $30 billion by 2028. So that's around a 15% growth CAGR. This growth CAGR is actually the quickest if you compare with other markets, say China, US, UK, they're all only growing at around single-digit growth CAGR. So a lot of investor feedback that we got is like Middle East, the size of Middle East is kind of small in terms of the TAM. But then if you look at the growth-wise, it's very difficult to find another region that has a similar mid-teens growth CAGR. So now, if you look at the chart below, so that is actually a proprietary assessment framework that we did on the entire GCC region. So so if we compare all the 6 countries within the GCC, Saudi Arabia actually ranks the highest in terms of all these metrics. So we have around 9 metrics in terms of like GDP, urbanization, and demographics, and then a lot of market dynamics matrix. So currently, Meituan is in Saudi Arabia now. So they started penetrating in Saudi last November, and they are now currently, as of today, they are in 9 cities, penetrating around half of the Saudi population in 3 months. So they are in 9 cities now. So the speed is kind of quick. And then we are expecting them to enter into UAE, which is also a very attractive market that we think by the second half this year. If their progress is on track, we also expect Kuwait will be very quickly to be penetrated, and so it could be similar to UAE by the second half of this year or early next year. So looking at this slide, this is because we actually went to on the ground checks. So we visited Dubai and Riyadh 2 weeks ago. So from our channel check, currently the market dynamic after Meituan entrance is that they got around 10% in order share. The top two players, Jahaz and Hunger Station, is actually not feeling much competition as of now, or they actually said that in their recent earnings that they didn't really experience any big competition from Meituan. But we think that is the major reason is because Meituan only entered into one city in 4Q. So so I think that this year the competition in Saudi is going to be quite competitive if you compare with 4Q last year. So in terms of like trajectory, we expect Meituan to be able to get around 20% share by 2028 if you look at the table on the right hand side. So Talabat is still a very dominant player. But then because Talabat is not in Saudi Arabia, so it is in all the GCC countries other than Saudi, and then it is currently around 60% share excluding Saudi. So in terms of the whole GCC excluding Saudi is 60%. So we do think that Meituan is going to face tougher competition if they enter UAE starting from second half this year, with Talabat being there for around 10 years plus. Brand awareness is actually very, very high. But then we also identified a few key items that we think Meituan is going to be able to gain share. So a lot of the on-the-ground competitors or investors that we talked to, a lot of them just thought that Meituan the core competitive for Meituan is to cash burn. So they think that Meituan will just keep doing a lot of discount, and this is how they're going to get share. We do agree to some extent that cash burning is one of their key core advantage, but we think other advantages mainly on their fulfillment. So they are able to deliver quicker than peers. They are very cost efficient. So they have only, the overhead cost is very, very low. So they only have rider cost as their major cost component, and then they are very fast to market. They expand very quickly. And lastly is they have a very high quality management that, if you can see from the Hong Kong example, that the execution is actually very superior. So yesterday from the news is that Hong Kong Deliveroo actually exited Hong Kong mainly because of the competition from Kita since last year. So we do see there are moats that Meituan has built in China and Hong Kong that we think they're gonna be able to gain more shares in the Middle East. And then lastly, I'll quickly go over some financials. So the key investor questions is actually on how much investments that Meituan is going to burn in the Middle East. I think revenue front is not the key market focus. We have $2 billion US in revenue assumption by 2028. But then the key is that if you look at the investment we put on the top left-hand side chart, we expect the investments in the Middle East will be around 700 million to 1 billion US annual. The biggest investments will be next year because we expect a full year of UAE, and then you also have other GCC countries. And now also the competition in UAE will be much higher, so we expect more marketing expense and more marketing investment subsidies, discounts will be needed next year. So that will be the peak investment at 1 billion. We also expect Saudi Arabia to break even by 2028, and you will still see a little losses from other GCC countries. So overall, we do, if you look at the right-hand side, it's on the new initiatives from Meituan. We do still think that the whole overseas expansion, because it's still loss-making by 2028, but then the domestic business, so for example, Meituan Select will be able to break even and deliver some profit by 2028. So I'll stop here for further questions, and you can refer to our insight report if you have further questions. I'll pass back to Daisy.
Thank you, Jen. So what is the major risk and key hurdles you see for Meituan expansion?
Yeah, so I think I've slightly talked about that just now. We do think there's a few. So firstly, it's regulatory wise. So in Saudi Arabia, which is like the biggest market in GCC now and where they are in now, there are actually some specific regulations in Saudi. For example, they are actually freezing new motorcycle licenses in Saudi since Kita's entrance last year in December. So that is mainly because of some road issues, so road safety issue, but that's only temporary. But currently it's still freezing new licenses. And then the second specific regulations in Saudi is that they need all the riders to be full-time licensed workers, so you cannot be freelance. So they have this transition of all freelance workers to be full-time riders in order to be eligible as a delivery guy. So these are some regulations that may hinder their expansion in Saudi, but we think it's temporary. And then the second hurdle that they might face is actually very strong incumbent. So Taliban is actually a very strong competitor. The impact now is not apparent because Taliban is not in Saudi, but they are very, very strong, and they have a lot of market presence in, say, UAE or Kuwait. So that's another one. And then the thirdly is because a lot of the competitors are actually doing quick commerce, so on-demand grocery. So a lot of these players already have a moat built with grocery side. So if Meituan is not doing grocery yet, a lot of the users may actually choose platforms that have both grocery and food delivery. So that could be another competitive advantage that the other players have versus Meituan.
Thank you, Joanna. There is another question for Lucas. So you mentioned the TSMC CoWoS capacity is fully booked until 2027. Are these guaranteed orders, or can these be canceled?
Yeah, thanks, Stacy, and yeah, thanks for the questions. To be honest, we don't know right now whether those 2027 order is guaranteed or not, or it's just an initial forecast. We don't know at this juncture. But even if it's guaranteed orders, we still believe that it can be subject to the market demand dynamics and also the order cuts. For example, if you take this year, for example, you can still see those ASIC CoWoS capacities cutting. So yeah, no matter that it's guaranteed orders or not guaranteed, we still believe it can be subject to market dynamic and also the order cuts. But I think, but we think that for what C.C. Wei have indicated during the press conference, he is quite confident on these on this capacity book, especially until 2027. So yeah, we think this demands these orders will some degree of guarantee, but we're still not sure how much is it. Yeah, thank you, Daisy.
Thank you, Lucas. So this question is for Joanna. What is the UE of Saudi delivery for Meituan versus the two top players?
Yeah, so thanks for the question. So Saudi, the largest two players is Hunger Station and Jahez. So we only have Jahez current UE, but then we can also compare with Taliban. So Taliban is not in Saudi, but also biggest in GCC. So if you compare the UE, Taliban has the highest margins and UE because of its scale and also its operations for decades. So the UE per order is around $1 US for Taliban. They have the highest margin across global peers at around 7% OP as of GMV margin. So that is the highest. And then if you compare with Jahez, which is much smaller if you compare with Taliban, currently at current level, their UE is around 0.3 US. So the margin is around 1.5%. So that is, but that has some one-off effect because they have some one-off incident last year, so that will be a bit lower. But then our UK analysts also think that on a steady state level, JAHAS will have around like a 4% OP over GMV margin. So we think on a steady state Meituan, that will be much over 2028. So we, on a steady state, saying like 5 to 10 years horizon, we expect Meituan to be able to reach a similar level as a steady state JAHAS. So in this chart, as you can see, we expect the UE for Meituan will be around like 0.5 US per order, and then the margin should be somewhere around 3 to 4%, similar as JAHAS, but then on a discount to Talabat 7% due to a very different in scale and also operations. Yeah.
Thank you, Joanna. So last question for Tiffany. Was the CoWoS double ordering from all players or only ASICs and Intel? And which CoWoS does NVIDIA use for Hopper and Blackwell models?
Yeah, so basically for order cancellation, we're majorly seeing the ASIC and also the GPU vendors like AMD and Intel. So basically AMD in last summer, they book around, excluding Xilinx, they book around 80K, but now cut to around 50K. And also Intel Habana, they previously have around 18 to 20K, but now it's also cut. So I would say, and Broadcom originally is around 90K for this year, and now cut to around 85K. So I would say these GPU and also ASIC vendors are releasing their full case targets and stick to what the true demand is more like right now. Yeah, for NVIDIA Hopper, it's using CoWoS X, and NVIDIA's Blackwell is using CoWoS L, and Rubin will also stick to CoWoS L. Yeah, thanks, Stacy.
Thank you, Tiffany. So in the interest of time, we conclude today's webcast here. Please do not hesitate to contact us if you have any further questions. Please also answer post-event survey if you think this session was useful. Morgan Stanley Research organized weekly TMT webcasts on every Tuesday from 11 a.m. Hong Kong time. We discuss most important topics in Asia. We look forward to having you again in next week. Thank you for joining us today.